Welcome everyone back to commercial banking class. This is a recorded lecture with a focus on the Tuesday night section in lieu of class for week 12 of commercial banking. Start as usual tonight with some housekeeping items. Firstly, wanted to speak to the midterm. We were able to get all makeups completed, graded exams, have had statistics posted, which you can see here out on Icon. I will have the exams available in class on Monday night tonight. They've already been in the finance office Monday throughout the day, and they'll stay there all of this week. I'll go pick up any leftovers next Monday before class and have them in class next Monday and Tuesday. But for those of you who'd like to see them in advance, you can pick them up there. And if you have any questions or concerns about those, I'd welcome you to send me an email or see me after class next week. We will spend some focus time in class next week looking over the questions on the exam, reviewing the answer key together, especially on some of the questions that had lower average scores. So overall, I was pleased, particularly with some of what I thought of as the more difficult questions. A lot of folks were prepared to answer the calculative questions. The structure of funds question is probably the one where there were the lowest scores. And on the whole, again, I was pleased. I like to see relatively tight relationship between the mean and median, and that was the case. And thank you for your work in preparing for that. Hopefully it was a good learning experience. So with that, let me move on. The content for this week, as usual, is posted on Icon. So you have the slide deck I'm going to speak from here, as well as an additional slide deck that I'll speak from in less detail, but I'd like to encourage you to review, and then one link to a Federal Reserve page. And so as we go here, we'll look over some things together related to those items. Really, this is part one of a 2-week series really on credit or lending policies. We'll do a brief overview today and then also touch on personal lending or retail lending, you might say. And then next week, focus more on commercial lending. We'll have a credit officer from Midwest One Bank with us next week to focus really on commercial or business lending. For those of you attending Monday night section this week, you'll hear from Jim Connard, who's also a business lender, but has diverse experience with personal retail and other things in his banking career. So you'll hear it straight from some current bankers or practitioners. But as always, we'll review the content here together as overview and amplifying some of the elements from the book. I will just say that the book, in my view, does a pretty good job on this topic. And so, as I've said at other times, going over something quickly or not focusing on it doesn't mean it's not important. Rather, the book does a nice job. So I'm supplementing here with some, statistics and other pieces of information that I think will be additional, not in lieu of the textbook. So from a big picture overview standpoint, policies and procedures writ large, we'll start there. As I said, this week we'll also talk about consumer or personal or retail loans. And then we'll have next week to focus on business or commercial loans. My hope is that you'd get a feeling for how banks make decisions on whether or not to lend money to a person or a business. As we've discussed, getting that right is probably the most important thing in banking in terms of managing risk. If you're bad at credit policy, in other words, if you're making loans that you don't get paid back on, it's going to be very difficult to be competitive in banking, okay? We're going to get a little bit into procedure around both personal and business lending. You've already heard a little bit from guest speaker Reed Jaksish and others on how that works, but we'll get into a little more nitty-gritty. How might a large nationally chartered bank do this? How might a community bank do this? What kinds of things are they concerned about or looking at, and so forth. So again, from a types of loan standpoint, this is just stating the obvious really, but these are some of the categories that you'll see. And when you get into your reporting in your real banks, which we'll do, you'll see that some of those are broken down into more detail than others. Quite often agricultural loans is an area that's potential for confusion. If you say buy a farm, is that a real estate loan or is that an ag loan? How does this relate to commercial loans? And really, bank by bank, you'll see some variation on that. We'll talk about that a little bit. First, big picture, how many loans are out there in the U.S.? And here we have some 2011 data. And you see those by size, and this is in the millions. So you can see that with large banks, as we talked about, large banks are nationally chartered banks. Banks over 10 billion in size obviously have much larger amount of loans than smaller banks. But even with some of the smaller banks here, you're talking about you'll see there 12 zeros. So large amount of money is lent. The banking industry, as we've discussed many times, very large, and so access to capital is an important part of our economy, and loans again are really at the core of what banks do. And so again, at this stage in the semester, we're thinking a little bit less about how to manage a bank and a little more about a specific task or role that might go on in a bank. So focusing now on a little bit of overview, but the primary focus this week and next is about how you do that within a bank. But going on here, the percentage of loans, the loans as a percentage of the overall assets on the books of a bank, as we've talked about before, larger banks tend to maybe take more of their money and invest it. Smaller banks, especially kind of that core mid-sized community bank, they're going to have a big percentage of their money lent. What kinds of loans do banks make? And again, you'll see some variation by size. And I think an interesting point to make here is that this isn't necessarily representing what loans were sold by a bank per se. This is what loans are on their books. So you may see a lot of banks, especially community banks, that make loans on, say, a mortgage for someone's home, say in Iowa City or North Liberty or wherever, and they may sell that loan to another bank. So while you see, for example, 100 million to billion sized banks here have less individual loans, that doesn't necessarily mean that they did less of those loans. It just means they're carrying less of them on their books. So that's a point I would make here. And probably the individual loans, as you can see, is the biggest area of variation. Large national banks tend to hold more of those than community banks. So this would be an example of the kind of question you might expect from me on an exam. So largest single category of loans issued by banks are real estate loans, and certainly mortgages are a big part of that for personal individual reasons. What would determine the mix of loans that a given bank may have? Well, you see some examples here. Certainly the risk profile or trying to manage risk as a bank is a big part of it, but also, just what kind of demand there is out there are going to drive a lot. So when I say characteristics of a market area, well, a small bank in a farm town is going to have a different appetite for agricultural loans than, say, a large nationally chartered bank in, say, New York City, obviously. But there are other niches or sort of elements to a particular market that might drive what kind of mix a bank may have on their books, what kind of mix of loans they may sell, even if they don't keep them on their books. Iowa City area is a good example of this. The banks in Johnson County do a whole lot of mortgage lending because there are a lot of new homes being built in the Creative Corridor, very growthy area, and so that's a big portion of the banking business that's done here locally. What do we mean when we say retail versus wholesale? There's been, I say, a big move to a more retail-oriented base in the last few years. There's been more and more of a movement, towards having more loans that you do be kept on your own books, as opposed to simply packaging funds that you purchased from elsewhere and doing those loans. Really, that's about managing risk and retaining as much profitability as you can at the same time, which is, of course, a balance. Related to that, I say twin goals of lending. We obviously want to do a lot of loans in a bank. That's how we make money, but we also need those to be loans that we're going to get paid back on. So that's really the rub of this credit policy idea. So we need to balance not only good loans for the right price, in other words, risk and return, but we also need to be aware of the liquidity requirements and restraints that we've talked about in recent weeks. Loans are also highly regulated, which we've talked about before, but you remember guest speaker Reed Jacks just talked about loan limits, and that's a reality for really every bank, but especially smaller community banks. There are also requirements out there, some of which I've outlined in the Reinvestment Act, the Equal Credit, and the Truth in Lending, that, if not limit, direct the kinds of loans banks would need to do to remain balanced, and what kinds of things they need to do really to have the right to serve a lending function in a community. Ultimately, all these things then result in a rating that a bank's going to get. You see this outlined in the text in good detail. But the better your ratings are, the less frequently you're going to get checked in on. And so these are some of the elements of the rating that a bank's going to get. And I described, I think, in an earlier week, the importance of high ratings, and that 1s and 2s are pretty customary. When you start to get into 3s, or certainly 4s, you've got a problem on your hands. So, and again, this is something that was outlined in pretty good detail in the book, and so I won't bemoan the details except to say that, this is outlining the sort of the risk profile of the bank based on their lending procedures, and this gives some nitty-gritty on how banks should approach that. So when you look at where banks are having trouble, what kinds of loans are not working out, these are some categories to consider. So criticized loans, or loans in critical condition, are ones that you might say, we want to keep a special eye on, but where there's no known issue. In other words, they're not missing payments, but we want to be aware of it. Maybe the borrower is not in as good a condition as they once were, that sort of a thing. Scheduled loans means that it's either the case that they have missed payments perhaps, or there's more significant reason to think that the loan may be in danger, okay? Or that the way the bank is lending around a certain area may be dangerous, as I write there. Adverse classification, when you see substandard, doubtful, loss, those are categories where there's an expectation there's going to be a loss on the loan. Okay, so loss, of course, being the strongest, that means it's a done deal. We're not going to be able to collect on the loan. Doubtful meaning that it seems very probable, and substandard again meaning it's likely. And so banks will start to account for those, as we've talked about, not only in making provisions to, based on estimates on what percentage of loans over time may not be paid back, but now starting to make accounting payments, if you will, to account for the loans we don't expect to get paid back. So you see some weighted averages here on how a bank may calculate those things. And as you look at your bank, this is an opportunity to review now the loan loss reserves and where the bank may be from a capitalization standpoint. Again, you can't have a whole lot of loans go wrong without having pretty significant problems from a liquidity standpoint for most banks. So actual no pays, I talked to you before about 2% being a sort of a rule of thumb in terms of percentage of loans that you might expect not to get paid back. Obviously that varies widely based on the kind of loan, and also based on the credit profile of the borrower, and those things are segmented. But 2%, sort of a rule of thumb. You see this skyrocket during the financial crisis all the way above 8% of loans that at least were non-current in some way. In other words, a payment was missed. So that's extremely high. When you think about the fact that most banks have around a 10% liquidity, that's a big portion of that liquidity that's being eaten up, and certainly the provisions for loan losses would not have accounted for that in a planning sense. Same kind of data based on the bank size. So larger banks are more aggressive, and they have a larger percentage of their banks or their customers not paying them back on the whole, you can see here. So let me pause there. We're going to break up the recording and we'll come back and do a part 2 here.